Coming up on At Issue, is it a buyer's market or a seller's market? National headlines all over claim a housing market recovery, but what's happening locally? We'll have two experts in our studio next to talk about the local housing market and what mortgage trends and changes are looking like. Find out where you stand next on At Issue. National headlines recently reading housing market recovery or something of the like, and many national outlets are claiming that after a long-time slump coinciding with the downturn in the economy, that the housing market is finally turning around. According to the Reuters, prices for new homes have risen every month since February of last year, enabling us the ability to call the state we're currently in a recovery. Some skeptics say we still have a long way to go, however. And one study even thinks Illinois is currently one of the worst states as far as a housing recovery goes based on high delinquency and foreclosure inventory rates. That study reported by MSNBC did mention, however, that the rate of new mortgages is fairly low when compared with other states, which will have to be addressed for this state's market to move forward, they say. Mortgage rules, rates, and trends are also playing a role in the ever-changing market. So where do we stand locally, and what do the local experts think? Well, with me today in our studios to answer those questions are Doug Stanberry, you're a realtor with All American Realty. Correct. Thanks for joining me today. And Juden Hayden, a mortgage lender from First Neighbor Bank down in Greenup. Yes. So we appreciate you both for joining me today.
Thank you.
And we're going to start off just by jumping right in with you, Doug. Is it a buyer's market or a seller's market from your perspective?
I'm going to answer that question as it depends.
Okay.
It depends on the house,
okay.
Quite frankly. I would say that overall, it's probably more of a buyer's market, but there are some listings that come on the market that have a lot of interest and kind of become, from the seller's standpoint, a seller's market. We've had some cases in the last few weeks where we've had multiple offers on some listings, and they've sold for maybe at or above the listing price, which is really unusual.
I was going to say that's something unique for this area, right?
It
you
is.
don't hear about bidding wars per se very often.
It is. In fact, when I look at last year compared to this year, as far as that situation goes, there were a few properties that would have sold for a list price. Mm-hmm. Generally speaking, no, it doesn't happen. Usually, offers do come in under list price, and homes usually sell for that. But again, it just depends on the property itself. You could have a property that's in very great condition, mm-hmm. and a very desirable floor plan, and you could have multiple offers on it, but it's really more of a rare case at this point.
Okay, because I'm hearing locally, and I live here locally, so I'm feeling that things are moving quickly around here. Is that is that true? Are they moving a little faster, or is this about the same pace we're always at? Maybe we just kind of have different perspectives sometimes.
Yeah, I think we're pretty much normal. I mean, as far as time on the market for this time of the year, mm-hmm. The trend seems to be, to me, in the last, I don't know, maybe since 2001, or maybe since 9/11, mm-hmm. we seem to, in Charleston anyway, we seem to have more of a seasonal market.
Okay.
Our market generally is more like maybe mid to latter part of March through probably July. Sometimes even August is going to be a little bit late, because most people want to be in place by the time school starts.
Right,
and
right.
we tend to see more activity in this time period of the year.
Okay.
I mean, we do sell homes every month of the year, but we
Sure.
definitely see more activity in the first half of the year.
Okay, and June, you're shaking your head. Does that kind of coincide with what you see in the mortgage lending trend as well?
Yes, it absolutely does. That time period that Doug referenced is a busier time for us as far as mortgage applications and mortgage closings mm-hmm. as well.
Okay. Yes. And so, first of all, I'd like you both to tell me, looking a little bit historically, because obviously there was that big downturn in the economy. So since then, kind of what have been the trends in each of your areas? Maybe we'll start with June. You can talk about mortgage lending trends, how we got into that slump, where it's going, that kind of thing from your perspective.
Okay. I don't want to say a lot about how we got into that slump. Sure. I think we probably all have some mm-hmm. Some ideas about that. But as far as where it's leading us now, we are seeing definitely stricter underwriting standards. And I might mention, and I know this is something that I've talked to a lot of people about, that our bank, as well as a lot of other banks in the area, I'm sure, are able to offer sometimes more flexibility than can be obtained from the secondary market. but we're definitely seeing stricter underwriting standards. We're also seeing more compliance issues, more disclosure that needs to be given to the borrower. So those are a couple things that come to my mind initially.
Okay. And with those, stricter guidelines and things like that, Doug, are you seeing that that is giving people trying to buy homes any problems, or is it just, another step to take?
I don't think it's a real big issue with a buyer trying to buy a home. I think the disclosure. I think Jean's probably talking about like disclosure as far as closing costs, and we have our own types of disclosures on the property itself, and it could be that the underwriters are probably a little more strict as far as anything that is on that disclosure that could be a red flag to that underwriter that could become an issue. But I don't really see that as a big problem.
Okay. So it's not stopping people from going out and buying homes?
No, I don't think so.
Okay.
No.
So really, what does that bubble down to the borrower? Is it just a couple extra steps in paperwork? Is it harder to get a loan, I guess is what I'm asking?
Definitely more paperwork required. As far as harder to get a loan, I would say not for most borrowers. Where we're seeing some of the stricter underwriting standards are in debt ratios. There was a time before the bubble burst when Freddie Mac would accept debt ratios as high as sometimes 70 to 80% of total gross income going to payments, which in my opinion is pretty high. High anyway.
Right. I mean, it sounds high.
And so now we're getting down to where they still normally will accept around 50%.
Okay.
So it's a little stricter, but still not eliminating most borrowers.
And that's pulled back in to protect the borrower, right?
Absolutely.
Okay.
Absolutely, yes.
Okay, that's what would make sense to me anyway, So would you say that we're, from your perspectives, in a recovery then? I mean, is this a housing recovery, or is this just a trend, or? That's a hard question to answer, I know.
It is. My opinion, based on my years of experience here, I've been a realtor here for 30 years. It seems that our local market lags the national market about a year. It just seems, when I look back over the cycles of the housing market, it seems like whatever we hear on the national news as far as the national averages, we tend to lag, I would say, about a year or so.
Okay.
What I'm seeing now is I'm seeing maybe an increase in foreclosures. I'm seeing more foreclosures now than we saw in the last 2 years, which is, again, is a lag, because I think nationwide we're not seeing that as much. And this could be an Illinois phenomenon too, because I know we are pretty low on the list.
Right, I mean, like I mentioned in that introduction, the study that said we're kind of at the bottom.
We are. I know as of like a year or so ago, I saw statistics where I think Illinois was in the bottom 5 as far as foreclosures. But I know from a local standpoint, I'm definitely seeing more homes that are coming on the market as repossessed properties. Now those properties have probably been in a legal transitional period in that foreclosure process for probably a year, sometimes 2 or even 3 years.
Sure.
So by the time they actually hit the market, but I'm seeing kind of an increase in that inventory of those homes coming on the market.
Okay.
So we really didn't have a huge bubble here like you hear about in Phoenix and in Las Vegas and Chicago and Miami. We didn't have that much of a huge increase in values and then a crash. Our market is just more stable, but quite honestly, I mean, we are listing some properties at less than what people paid for them, like within the last 5 years. Just based on comparable sales.
Sure.
So.
Okay. Yeah, that's interesting. To mention the lag, because that seems like not even just in home buying, but in everything. As far clothing trends, anything. It seems like this part of Illinois, or maybe even just Illinois, seem to lag behind in some of the trends sometimes. So that's an interesting point to bring up there. So do you see now that there are more pre-qualifiers getting out there? You need to have that pre-qualification in hand. Is that something that's far more necessary than maybe it used to be?
it is vital.
We're seeing
It is vital. Definitely, because it is, as June said, it is tougher to get a mortgage.
Right.
So if that buyer, if they're unwilling to get that pre-approval letter or pre-qualification letter, then that pretty much tells us, well, then there's a problem, and that they probably are not going to qualify for a mortgage. If they resist our suggestion, to get that pre-approval, we know that there's probably a reason. So it's very important, and it's especially important that you have that pre-approval letter, that pre-qualification letter, so that when you do find the perfect home, you're in a better negotiating position, because you could be competing against another buyer that has their ducks in a row. So it's very, very important that you have your financing pretty much lined up before you even really start seriously looking at homes.
And is that something you recommend as
I
well?
would say one of the first things to do before you start shopping for a home is to come in and see your banker, make application, and obtain that pre-approval or that pre-qualification letter.
Right, because it's as simple as, that mortgage lender will give you a letter that says, our bank will loan this person up to this amount of money, or whatever it is, and then you take that and you have that leverage when you're buying a home. Okay, so that's good to know. And is that a simple process for people that aren't familiar with it, if you need to go in and get pre-qualified?
Oh, absolutely it is. These days you can probably even go online and make application as well, or you can come into one of your local banks and make application. And the applications are not difficult, but the help is always available too if there are any questions. You had mentioned earlier, or asked if there were things that would speed up the process. And one thing I would suggest to people when they're coming into the bank to make application is bring a month's worth of pay stubs with you. Bring your last 2 years W-2s, because those are pretty important pieces of information. Those will be used to calculate your income, which obviously income is a very important part of the pre-qualification process. So if you can bring those, or if you're a self-employed individual, bring 2 years of taxes, income taxes. So those are just a few things that you can bring with you to help expedite the process.
Okay. And so are you seeing, when people come in to get mortgages, are you seeing more first-time home buyers? Same for you, Doug, are more people buying homes for the first time? Are people moving right now? And may that have anything to do with possible changes in mortgage rates and things like that?
Well, I would have to say I don't really see any trend as far as more first-time home buyers, or I really can't say that I see any kind of a trend. No, I don't. I mean, people are motivated by all different kinds of reasons. Job change, or unfortunately, people passing away, people getting a divorce. I mean, there are a lot of reasons for people to put their homes on the market.
Right, a lot of variables.
Right, that create our inventory. And the same way, when you have people wanting to buy a home, I mean, they're motivated by different reasons. I would say that what is surprising to me is that with the interest rates at such historically low rates, that we're not seeing more first-time home buyers.
Yeah, I guess that was my question. The rates are so low. That's unusual. So you would think that would motivate people to go out and buy.
You would, and I guess by the same token, people to move up in housing too, rather than refinance. Go ahead and maybe increase their, get a larger home, or go into a different property. But we don't see that. We really don't see people, they're not just going to go out and buy a new house just because the rate's low.
Right.
They really have to have another motivating factor. So, but you would think that there'd be more people, trading around with the rates, but we don't see that. And I think it's because there are several reasons. I think one reason, a lot of people are they just have too much debt.
Okay.
They have too much debt the way it is, and they just don't. They're not willing, or they're not sure about their jobs. Right. There is still a great deal of uncertainty in the economy.
So some of that economic downturn left over that is affecting people in that way too.
Absolutely. I don't see a great optimism as far as the economy is concerned. As far as our local market, and I think that's pretty much in a lot of the state.
Sure. Okay. And June, are you seeing the same thing? I know it felt like, maybe you can shed some light on this, it felt like a lot of people ran out and refinanced when the rates went down.
Yes.
Is that something that did happen? Did you get busy seeing that?
Oh, absolutely. And actually, I kind of looked at some numbers, and last year, about 70% of our mortgages were refinances.
Wow. That's a lot.
Much to our dismay.
Right, I'm
Quite
sure.
frankly. Yes, we really don't like to see that. We really don't like to see people refinance. We want to see them sell that home and go into something
Right.
else.
Out of that house, right?
Yes,
That would make sense from the realtor standpoint, but from the banking standpoint, I'm sure you love to see them when they're, no matter how they're coming. So
Absolutely. Sure.
But wouldn't you rather deal with a new purchase than a refi?
Oh, yes.
Yes, it's just
Purchases are always so exciting,
It
and
is.
particularly for first-time home buyers.
exactly.
That's one of the most rewarding things of, that happens in my job, is to be able to accommodate a person buying their first home.
Okay. And so do you think, you know, because nationally, I don't know whether this will be true locally or not, or how it will affect us locally, but you know, they're projecting that the rates will start to creep back up. And I know they're already starting to creep just a little, you know, not even a noticeable amount, but do you think, you know, that will show in refinances and things? Do you think that trend will slow down thanks to the rate going back?
Absolutely, yes. Because so many people who have the ability and the interest in refinancing have already done so.
Okay.
So certainly as rates begin to increase a little, I think we'll definitely see a slowdown.
And are there changes on the horizon for the mortgage laws that might affect the way people refinance and, you know, get their first-time loans and things like that in the coming years?
Not so much first-time loans, but there are many changes coming. Most of them are scheduled to take place January of next year.
Okay.
So right now in the banking industry, we're gearing up for those changes. The changes will definitely, of course, have an effect on buyers and borrowers, but they probably will have more of an effect on we lenders,
Okay.
and how we have to do business.
And can you run over some of those changes? Are there some that you would?
Disclosures are changing.
Okay.
Disclosures changed 2 or 3 years ago, and there are more changes coming in the disclosures. And by disclosures, I mean, you know, we are required to disclose to the customer what we intend to do with their loan, whether we intend to sell their loan, keep it in-house. More importantly than that, probably is the disclosure, or more importantly, as far as changes, was the disclosure in the what is called the good faith estimate. That's an estimate of closing cost. There are more changes coming just in those forms. There are also changes coming as far as verifying a borrower's ability to repay, and there are going to be more set guidelines, more firm guidelines than what were previously prescribed by the government.
Okay.
So yeah, a lot
And
of
this is all for protection of both entities, right?
Well, yes,
Mostly
and
consumer.
particularly consumer protection.
Okay.
Yes, there's a big push for that now.
Okay.
More documentation is required and verification of that documentation.
Okay. So it's not getting simpler.
No, not for anybody.
Okay. And Doug, you know, do you see that affecting the real estate market at all? As those changes come and get a little more stringent every year, is that doing any effect on your work?
I really don't think it is. I don't think so. I think
It's one of those, it is what it is things.
Yeah, and they've got to get the loan. So you know, what they have to go through to get the loan, really, I don't really see that as an impediment as far as people buying.
Okay.
They just have to jump through those hoops. And as June said, really, a lot of these rules are designed to protect the consumer.
They really are.
And I think to a lot of extent, they're kind of the way things used to be
They are.
before the regulations were so relaxed back in like 2005, 2006.
2007 is when it got really bad.
Exactly.
So.
Because I can remember back years ago when people would make a loan application, everything on that application had to be verified.
Right, right.
And they got away from that. People
they
could go online and get an approval in 5 minutes, and nothing was really verified. So.
And then low doc or no doc loans.
Oh, okay, yeah.
And those are history.
Right. That's kind of next thing I was going to ask. Are there programs or types of loans and things that are now obsolete thanks to these changes?
Yes, and one particular program that comes to mind for me is, and in our particular bank, we deal a lot with Freddie Mac loans, and Freddie Mac used to have a program called Streamlined Refinance, and that is out the door now. That particular program was a very low doc program. A borrower who had an existing loan and had a good repayment history we were not required to obtain a new appraisal, and we had to obtain a credit report, but we really didn't have to worry about what was on the report as long as that borrower had made his or her house payments. Well, again, that is history. Now, when a borrower comes to refinance, they're going to have to go through the same procedure as if they were a new customer.
So that's definitely changing.
Definitely.
You know, we deal a lot here with the rural development loan program too. Is that something that's going to be changing?
Other than the general changes, which will affect everyone,
Right.
I'm not aware in particular of rural development itself changing. Now, Doug, there may be some changes that may affect
Yes.
Charleston specifically,
Yes.
as far as property eligibility.
Are you
Correct.
seeing things coming down the pike with that?
Well, yes. Unfortunately, we are told that the rural development program will not be available to properties in Charleston after April, I believe the end of April perhaps?
The date that I was given was the bank must have a conditional commitment from rural development by March 27th.
Okay, okay.
Now that would be the commitment. The loan could close after that.
Correct.
Okay.
The
Correct.
That's
commitment
coming up
must be
fast then.
obtained. Yes.
It is, and quite frankly, that will affect our business.
Yeah, I was going to say, what does
perhaps.
that do?
We don't, it hopefully will not affect the number of homes that we are selling, but it's going to change the costs for the buyer.
Okay.
Because what some of the banks are recommending as a replacement for RD in the Charleston market would be an FHA mortgage.
Okay.
And with an FHA mortgage, and June, if I'm wrong, correct me, but there's a minimum 3% down payment, and a new rule with FHA is formerly you had to escrow real estate tax and insurance with FHA until you had 20% equity in the property.
Okay.
Well, I heard that is going to change where you have to carry the MGI. I'm correct myself. It's not the escrow. Well, probably the escrow too, but the mortgage insurance.
mortgage insurance.
You have to
Mortgage
carry.
insurance.
You have to carry that.
I had heard that as well.
Yes, and that will be for the life of the loan. After I think coming up here for
I'm not
too
certain
long.
on the date of that.
Yeah, yeah. So that's just an added cost to the consumer.
And it's going to change the way, some people shop, I'm sure, because they may have to wait till they have a certain amount of money to put into that now.
Correct.
So.
Or it will change the amount of home that they can qualify for.
Absolutely.
To some extent.
One thing I had noted in addressing the changes in borrowing trends was that I am seeing, at least from my perspective, more borrowers who are not even able to get together that required 3%.
Wow.
So we were looking at, for home purchase loans, a lot of the rural development or the 100% financing. So I can certainly see how that will
and
have
that was something that came to mind too.
on the Charleston market.
Yes.
Yeah.
It's a wonderful program, and we're really going to miss it. And from what we're being told, the reason that Charleston won't qualify is because of the population. That the government is counting the student population as the total, and so that will bump us above the maximum population. Greenup, KZ, even Mattoon will still be able to. People will be able to buy homes in those communities with the RD program, but not Charleston. So we sell a lot of homes that are financed through our development.
Yes,
That was something else that came when you were talking about 100% financing. Do you see a lot more of that? Because if people are having higher debt ratios, are they having to take 100% loans instead of putting money down? Because I know in the past, it was almost, maybe 20 years ago or so, 20% down. That's just what it was. You just always put 20% down and you didn't buy until you had that. And, are there a lot more 100% loans now?
Definitely, we are seeing a lot more 100% loans. And then also, there are those borrowers that do not have to borrow 100%, but they're going for the maybe 90 or 95% with the private mortgage insurance enhancement. So definitely we're seeing really and truly very few borrowers having the 20% cash.
Right. Well, I imagine, in today's society, it's kind of hard to gather up, especially depending on, the amount of home that you might want to buy. It's
right, and with home prices increasing,
money.
and they have been increasing over the past several years, so definitely. Yes.
Are you seeing that too? The home prices do increase around here?
You know what? I would have to say in the last few years, we're really not seeing a big increase in homes. They're pretty stable, I would say. Some homes have lost value. If people do not take care of them, if they don't maintain them properly, they will lose value. But we're seeing property values, fairly stable, but not really increasing a lot, but not really losing a lot of value. Like I said, unless there are a lot of factors that can work into what a property's value is. If it's priced too high originally, that can really hurt the ultimate sales price of it. Like I said, the condition is very important. Homes that are not maintained lose value almost exponentially, because buyers walk in and they see work they need to do, and they will, it may cost them $5,000 to bring the house up to their standards, and they'll come in at 10 or 15,000 under list price on their
Right,
offer.
because they see that as money
They
that
do.
they're going to have
They
to
do.
spend.
They
Okay.
do.
Oh,
Yeah.
and Doug, I
Yeah.
might mention, when I talked about prices increasing, I was talking about from several years back, not in the last few
Oh,
years.
right, yes.
Because
Oh,
we
yes.
know we're not
Sure.
seeing an increase. In fact, another thing that can become a problem for us and for our borrowers who are wanting to refinance is that sometimes when they come to us to do the refinance loan, which now remember does require a new appraisal, even if it's only a rate and term refi, those appraisals sometimes are unfortunately coming back lower than what the appraisal was a few years ago when the borrower took the original loan. So no, we definitely are not seeing an increase in housing prices at this particular time.
And I know people are always concerned about those appraisals, because that depends on the amount of the loan and things like that. So, kind of as we close up here, what's some quick tips that you would have while we navigate this kind of changing market here from both your perspectives?
I would have to say, save your money.
Absolutely.
Save your money.
Of course, the banker's going to say that too.
Yes. So that you can qualify for the mortgage.
Okay.
So you can save your money so you can see June and get approved for a mortgage, then come see me. So so you definitely, you've got to have money saved. You've got to have your credit scores have been increased as far as to finance for a property, and I would also say too, and this is a trend that I have noticed, that we're in a period of such incredibly low interest rates that even though we're so low as far as interest rates, new people, young buyers, first-time home buyers that are getting into the market, to them, that is kind of a benchmark. So if they see rates go to 5%, they think the rates are really high. And when I got in the real estate business back in the early 80s, the interest rates were 12%.
Double digit.
And they had been 18 and 20% before that. So I can remember when they came below 10% in my career, it was like, hallelujah, rates are finally getting below 10. But so now, with, like I said, with the first-time home buyers or people that are in the market for the first time now, they watch those rates, and if the rates go up 1/4%, they think it's like the end of the world. So it's really interesting the perspective that they're coming from, that they really think those rates are really high if they get to 5%, and it's so low.
All right. Well, we're out of time for today. We thank you both for coming. It was a great conversation. And we appreciate all you out there watching At Issue. We'll see you next time.